What if the biggest move in the silver market is already happening, but most investors still cannot see it? What if governments, large institutions, and the most powerful traders in the world are quietly positioning themselves before a major price explosion in silver and gold? Today, we are going to break down something very important that almost no one in the mainstream media is talking about. There are growing discussions about a hidden strategy sometimes called Project Vault, a plan that could involve building strategic stockpiles of critical minerals like silver and platinum. If that idea is even partially true, it could completely change how the precious metals market behaves in the coming years. Welcome to Gold Silver Scope, where we break down the real forces moving the gold and silver markets in simple and clear terms. Today, we are looking at signals coming from the physical silver market that suggest something much bigger may be developing behind the scenes. For years, investors have expected the price of silver to eventually explode higher. But something strange keeps happening. Every time metals begin to rise strongly, the market suddenly experiences sharp pullbacks, unexpected selling pressure, or technical glitches. These events often appear during important moments when momentum starts building. Many analysts say this is just normal liquidity management, meaning traders sell metals first during uncertainty because they are highly liquid assets. But others believe there may be something deeper happening. There is an old concept sometimes described as the management of perception in financial markets. The idea is simple. Sometimes the price movement of important assets is influenced in ways that shape public expectations. When metals rise too quickly during uncertain times like geopolitical tensions or financial stress, it can send a powerful signal to the world that something is wrong with the monetary system. Gold and silver are not just commodities. For thousands of years, they have been viewed as real money. When their prices rise quickly, it often reflects declining confidence in currencies, rising inflation, or growing debt. That is why many analysts believe gold and silver prices sometimes move in ways that are designed to manage market psychology. When uncertainty grows, metals often experience sudden downward pressure. But interestingly, these pullbacks sometimes happen at moments that do not fully make sense from a fundamental perspective. Instead of discouraging long-term investors, these corrections may actually give the market one more opportunity to accumulate physical metal before a larger move begins. One of the most important signals investors should watch is not the daily price movement. The real signal comes from the physical market, especially deliveries taking place through major exchanges. Over the past 16 months, something extremely unusual has been happening. Physical deliveries of silver have been occurring at levels rarely seen in modern market history. Large traders, institutions, and well-capitalized participants are consistently standing for delivery of physical silver month after month. To understand why this matters, we need to understand the difference between paper trading and physical metal. Most silver trading happens through futures contracts and financial instruments that represent silver rather than actual bars. But when someone stands for delivery, they are requesting the real physical metal. That means someone somewhere must provide actual silver bars to complete the transaction. For 16 consecutive months, deliveries have remained extremely strong. This suggests that the most informed participants in the market may be positioning themselves for something bigger in the future. These traders often have access to deeper market information, supply chain insights, and long-term strategic thinking that retail investors simply cannot see. Think of it like a famous sports strategy. Instead of skating to where the puck currently is, the best players move to where the puck will be in the future. In financial markets, the smartest capital often behaves the same way. They accumulate assets quietly before the wider market fully understands what is happening. What makes this situation even more interesting is that much of the silver being delivered is not simply staying inside the exchange system. In many cases, large quantities of metal are being physically removed from the exchange vaults. That means the silver is leaving the trading system entirely and moving into private storage, industrial supply chains, or long-term strategic reserves. When this happens consistently, it slowly reduces the amount of available silver that can support futures trading. Over time, this can create tension between paper markets and physical supply. And when that tension becomes large enough, price movements can suddenly become very dramatic. This is why many analysts believe the current silver market may be approaching a turning point. The physical demand signals we are seeing today suggest that the smartest money in the world may already be preparing for a major shift in the precious metals market. While the mainstream headlines continue focusing on short-term price movements, the real story may be unfolding quietly in the background through the steady transfer of physical silver. And if that trend continues, the market may eventually reach a moment where price can no longer ignore the reality of tightening supply. But what makes this situation even more mysterious are the strange events that have happened inside the metals markets recently. From sudden trading halts to technical glitches that seem to affect only gold and silver markets at very unusual moments, many investors are starting to ask deeper questions. And in the next part of this analysis, we are going to examine those events closely, along with the unusual delivery numbers and the massive amounts of silver that appear to be leaving the exchange system. Because once you see those numbers clearly, the picture of what might be happening in the silver market becomes much more powerful. In the first part, we discuss the unusual signals coming from the silver market, especially the massive physical deliveries happening month after month. Now let's look deeper at what is actually happening inside the physical silver system, because the numbers themselves are telling a very powerful story. Normally, commodity exchanges operate with a balance between paper contracts and the physical metal stored in their vaults. Futures contracts allow traders to buy and sell silver without necessarily moving the physical metal. Most of the time, these contracts are settled financially rather than through actual delivery. That is why the volume of paper silver trading is usually much larger than the physical supply sitting in vaults. But over the past 16 months, something very unusual has been happening. Large numbers of traders have been choosing to stand for delivery. That means they are not just trading contracts anymore. They are demanding real silver bars. In some recent months, between 30 and 70 million ounces of silver have been delivered. Even in months that are not considered major delivery months, tens of millions of ounces are still being taken out of the system. For example, one recent delivery period saw around 25 million ounces delivered, which normally would already be considered significant. But the real surprise came afterward. More silver left the exchange than the deliveries alone could explain. In fact, the amount of silver that left the vault system was roughly 160% of the metal that had officially been delivered. That raises an important question. Who is removing all this silver, and why? When physical metal leaves an exchange vault, it usually means someone wants to store it privately or move it into industrial supply chains. Unlike paper contracts, this metal is no longer part of the trading pool. It is physically gone from the exchange system. To understand the scale of this movement, imagine the weight involved. A standard mint box of silver coins contains about 500 ounces and weighs around 42 pounds. Now think about moving tens of millions of ounces out of vaults. That represents an enormous physical transfer of metal. This kind of movement does not usually happen unless large institutions, governments, or major industrial users are securing long-term supply. And this is where the situation becomes even more interesting. Recently, silver was officially classified as a critical mineral for national security. This is extremely important because it means governments now recognize silver as a strategic resource, not just a commodity used in jewelry or coins. Silver plays a critical role in many modern technologies. It is essential for defense systems, aerospace equipment, advanced electronics, communications infrastructure, and energy technologies. It is also heavily used in solar panels, electric vehicles, and emerging artificial intelligence hardware systems. In other words, silver is no longer just a precious metal. It is a core component of modern industrial development and national security infrastructure. And here is the key point. This demand is not optional. When the military needs silver for defense technology, they do not stop buying it just because the price rises. The same is true for industrial demand. Factories, technology companies, and energy producers require silver to manufacture their products. That demand does not simply disappear overnight. At the same time, the global silver market has been experiencing what analysts call a structural deficit. According to industry data, the silver market has been in deficit for several consecutive years. A deficit means the world is consuming more silver than it is producing through mining and recycling. This is a very important long-term signal. If demand continues to exceed supply year after year, eventually the market must correct itself. The only mechanism that can rebalance supply and demand in a commodity market is price. In simple terms, if silver becomes harder to find, the price must rise in order to encourage more mining and reduce excess consumption. But there is another complication in the silver market. For many years, large volumes of silver have been traded through paper contracts that may represent more metal than actually exists in physical form. As long as most traders settle contracts financially, the system continues to function smoothly. However, when more participants begin demanding real metal instead of paper settlements, pressure starts building inside the system. And that is exactly what we are seeing today. Large investors appear to be quietly accumulating physical silver, while the broader public remains focused on short-term price movements. Meanwhile, the amount of silver leaving exchange vaults continues to grow. This creates a situation where the visible market price may not fully reflect the tightening physical supply underneath. Eventually, these two realities must reconnect, and when they do, the adjustment in price may not happen slowly. In commodities with strong industrial demand and limited supply growth, price corrections can happen very quickly. That is why some analysts believe that when silver finally breaks out into true price discovery, the move could be extremely powerful. But the story does not stop there. There are also growing discussions among major financial institutions about how high silver prices could eventually go if these supply pressures continue. When we combine all the signals we discussed in the first two parts, the picture that begins to emerge is quite powerful. Physical deliveries are rising, silver is leaving exchange vaults, global supply deficits continue year after year, and industrial demand keeps expanding through technology, energy systems, and defense industries. All of these forces point toward the same conclusion. The silver market may be much tighter than the current price suggests. Some major financial analysts have started discussing scenarios where silver prices could rise much higher over the next few years. In certain projections, analysts from large financial institutions have suggested that silver could potentially reach levels far above what most investors currently consider realistic. Now, forecasts should always be taken with caution. Markets are complex, and many variables can influence price movements. But the fact that these discussions are happening inside major financial institutions shows that the silver market is gaining serious attention. Another important shift is happening in the way investors think about portfolios. For decades, the traditional investment model followed what was known as the 60-40 portfolio. That meant 60% of assets in stocks and 40% in bonds. But many analysts now believe that model may be breaking down. Rising government debt, inflation pressures, and uncertainty in global financial systems are forcing investors to rethink how they protect wealth. Some analysts have suggested reducing exposure to bonds and increasing allocations to real assets, including precious metals. Gold and silver historically perform well during periods of monetary uncertainty. When confidence in currencies declines or inflation rises, investors often turn toward tangible assets that cannot be printed by central banks. And there is another factor that could accelerate this trend: geopolitical instability. History shows that major global conflicts often create strong upward pressure on gold prices. War typically increases government spending, expands debt, and forces central banks to print more money to support economic activity. All of these conditions are traditionally bullish for precious metals. Silver, because of its dual role as both a monetary metal and an industrial metal, can sometimes react even more dramatically than gold during these cycles. But here is something many investors forget. Silver markets have spent many years trading within controlled ranges. Some analysts believe that precious metals have never fully experienced true price discovery because of the complex structure of global financial markets. If that structure begins to weaken under pressure from physical demand, rising deficits, and geopolitical uncertainty, the repricing of silver could happen very quickly. And that brings us back to the core question many investors are asking today: is it already too late to participate in the silver market? From a long-term perspective, many analysts believe the answer is no. If the structural forces we discussed continue to build, the current stage of the market may only represent the early phases of a much larger trend. Silver demand continues to grow across technology, defense, renewable energy, and artificial intelligence infrastructure. At the same time, new silver mining projects take many years to develop, which means supply cannot increase quickly. When supply growth is slow but demand keeps accelerating, markets eventually adjust through price. This is why many long-term investors continue watching the silver market very closely, because sometimes the biggest opportunities appear when the majority of people are still focused on short-term noise instead of long-term fundamentals. If you want deeper analysis like this about gold, silver, and the global precious metals market, make sure you follow Gold Silver Scope. On this channel, we break down complex market developments into simple insights so you can better understand what may be happening behind the scenes in the world of precious metals. And remember, the goal is not just to watch price movements, but to understand the forces driving them.